Welcome to Iron Financial, where we forge stronger portfolios by stress testing the market's biggest names. We don't just glance at the surface, we take a sledgehammer to the financials to see what holds up and what crumbles under pressure. Today, the energy giant Shell is on the anvil. They've just dropped their Q4 and full year 2025 numbers, and we're about to find out if this company is built from solid iron or just painted to look like it.
All right, let's get right into it. The first thing you always see in these earnings releases is the message from the top. And Shell CEO Wael Sawan, he painted a masterpiece of strength and momentum. You hear words like accelerated momentum, strong performance, solid cash delivery. This is the official blueprint they want you, the investor, to see. It's a gleaming, perfectly engineered structure designed to make you feel confident, to make you want to put your capital in. This is the story they are selling.
But hang on a second. If that blueprint is so perfect, then why did the market immediately start knocking down the walls? The stock dropped almost 2% in early trading right after the announcement. Now that doesn't sound like accelerated momentum to me. It sounds like the market, the first line of defense with real money on the line, it looked at the CEO's beautiful blueprint, then it glanced over at the actual structure, and it saw something it really didn't like. That is a huge red flag. When the story from the C-suite doesn't match the immediate reaction from the market, well, that's our cue to start digging.
Exactly, and that's the conflict we're here to resolve today. Look, this isn't just about one bad quarter. This is about the long-term structural integrity of a massive global company. So today, we're putting Shell through our full iron financial stress test. First, we'll look at the CEO's words versus the market's actions. Then, we're going to inspect those headline numbers, the polished facade they present to the world. After that, we go deep, right into the engine room to check the cash engine. Then we'll test the debt foundation and finally see how they're handling shareholder payouts. By the end, we'll deliver our final verdict. Is this foundation solid, or are there dangerous cracks hiding just behind the commentary? Let's get to it.
So right out of the gate, we've got the company saying one thing and the market, with that immediate 1.9% drop, doing something completely different. This is the classic disconnect we look for. The CEO is selling this story of strength, but the very first people to put their money where their mouth is, the traders, they're selling the stock. This isn't just market noise, it is a clear signal that the market is skeptical of the official story. Our job is to find out exactly why.
Okay, so let's start by looking at the building's exterior, those headline numbers that everyone sees first. Now, on the surface, things look a little mixed, and this is where the confusion can start for a lot of investors. You've got to look past the first number you see. It's designed to be easily digestible, sure, but the real story is always in the details.
And here's that split decision. They beat on earnings per share, reporting $1.86 against an expected $1.72. Now, for a lot of automated trading systems and for people just reading headlines, that's a green light. That's a clear win. But, and this is a really crucial but, they missed on revenue. The consensus was for over $70 billion in sales, and they came in at $68.15 billion. That is a significant miss of over $2 billion on the top line.
And this is a fundamental question every single investor needs to ask. An EPS beat, yeah, it feels good, but revenue is the lifeblood of a company. Revenue is what you actually sell. You can manipulate earnings per share through a dozen different levers. You can cut costs aggressively, you can buy back shares to reduce the count, you can make all sorts of accounting adjustments. But you can't fake revenue. Revenue represents real demand for your products at a real price. So when revenue misses, it suggests a core weakness, either in demand for what you're selling or in your power to price it effectively. Is that polished facade starting to show some serious wear and tear?
It's way more than just wear. When you step back and look at the whole picture for the entire year, you see a significant structural crack. Full-year adjusted earnings dropped from $23.7 billion in 2024 all the way down to $18.5 billion in 2025. That's a 22% decline, a massive drop. This isn't just a minor chip in the paint. It is a crystal-clear indication that the weakness on the top line, that revenue miss, is flowing directly through the business and hitting the bottom line, hard. That accelerated momentum the CEO talked about, it is nowhere to be found in the most important profitability metric for the whole year.
All right, so earnings can be managed with accounting. Adjusted earnings are just that. They're adjusted. But cash is king. Cash is the ultimate reality check. It's what pays the bills, it's what funds the investments, and it's what returns capital to shareholders. Cash doesn't lie. So let's leave the polished exterior behind and let's go down to the engine room. Let's check the cash flow. Is this machine still printing money, or is it starting to seize up?
The engine is sputtering. Badly.
Now, what's really striking about this slide is just the sheer scale of this decline. Cash flow from operations, CFFO, it plummeted from $54.7 billion in 2024 down to $42.9 billion in 2025. That is a nearly $12 billion drop. It's a 22% collapse in the primary engine of the business. This is the single most important number to understand. Everything the company wants to do, from paying dividends to servicing debt to investing in the future, it all relies on this number, and it is losing power at an absolutely alarming rate.
So, with the main engine losing power, let's break down where the remaining power is even coming from. This table shows the adjusted earnings for the full year, segment by segment, and the story it tells is one of extreme concentration. Just look closely. The two load-bearing pillars are clearly integrated gas at $8.2 billion and upstream at $7.4 billion. You combine those, and that's over $15.6 billion of the total $18.5 billion in earnings. These two legacy divisions are doing all of the heavy lifting. I mean, they are accounting for a staggering 84% of the company's total adjusted earnings. Everything else is almost a footnote.
So the old guard, the fossil fuel business, LNG, and traditional oil and gas production, that's what's holding the entire structure up. This is the legacy engine that is still running, and it's running hard. But a company this big can't just rely on two pillars forever, right? Especially in a world that's supposed to be transitioning its energy sources. So what about the newer parts of the business? Are they adding to the foundation, or are they just dead weight, dragging it down?
Oh, they are absolutely weighing it down. And this just brilliantly illustrates one of the biggest problems. The chemicals division alone posted a negative adjusted earnings of over $1.1 billion in 2025. Let me be perfectly clear about that. That is a loss. This segment isn't just underperforming, it is a massive cash furnace, and it is actively burning through the profits being generated by the gas and upstream divisions. It is a structural weakness that is actively draining resources from the rest of the company. It's a billion-dollar hole in the hall. And the renewables segment? After all the talk, all the marketing, all the promises about the energy transition, this division generated a paltry $200 million for the entire year. That is just over 1% of the company's total adjusted earnings. Now, okay, to be fair, turning any profit is an improvement from last year's loss, but for a company of Shell's scale, it's a rounding error. It contributes virtually nothing to the structural strength of the company. The new modern parts of this building, they aren't carrying any weight at all.
So let's keep going and see how this all builds. With cash flow falling sharply and entire business segments just bleeding money, you have to check the foundation that the entire structure rests on. So let's look at the balance sheet, specifically the debt load. A company can survive a bad quarter, even a bad year, if its foundation is solid. But if that foundation is weak, the whole thing can come down, and it doesn't matter how strong the top floors look.
And that is a heavy, heavy number. A nearly $46 billion debt burden. Just think about that for a second. That is an enormous weight just sitting on the company's foundation, a foundation that we've just seen is being supported by a sputtering cash engine. A weak foundation can bring down the strongest-looking structure, and this is a lot of weight to carry. The crucial question is, how has this been trending? Is that burden getting lighter, or is it getting heavier?
Well, it's trending in exactly the wrong direction. This timeline tells a very clear and a very concerning story. At the end of 2024, net debt was already high at $38.8 billion. By the end of Q3 2025, it had climbed to $41.2 billion. And now, just one quarter later, it has ballooned to $45.7 billion. That is an increase of nearly $7 billion in net debt in just 1 year. The foundation is taking on more and more weight at the exact same time the cash engine that's supposed to support it is losing power. This is a very dangerous combination.
And this pushes their gearing, which is a key measure of financial leverage, it's basically debt relative to equity, up to 20.7%. Now that is a very notable increase from 17.7% just a year ago. So the crucial takeaway here is that the financial risk profile of this company is increasing. The leverage is getting higher. They are adding more stress to a foundation that is already showing very clear signs of strain. This is not a sign of a healthy structure.
Okay, so let's just quickly recap the stress test so far. Cash flow is down significantly. Debt is up significantly. Entire divisions are losing money. So logically, you would expect the company to pull back, right? To conserve cash, pay down some debt, and fortify the balance sheet. You'd expect them to start reinforcing that foundation. But incredibly, that is not what they're doing at all.
Not at all. In fact, they're doing the exact opposite. They are flooring the accelerator on shareholder distributions, even as the fundamentals of the business get weaker. First, they're increasing the dividend by another 4%, a signal of strength that just doesn't seem to match the underlying numbers. Second, they're launching another massive $3.5 billion share buyback program, using cash to prop up the stock price. And third, and this is the most critical point, this brings their total shareholder payout for the year to 52% of their cash flow from operations. Now, their own stated target range is 40 to 50%. They're breaking their own rules to send cash out the door, and they're funding it with a shrinking cash flow and a growing pile of debt.
Sacrosanct. That is a very strong word. It means sacred, inviolable, something that cannot be questioned. The CFO is signaling that they are committed to this path of aggressive shareholder returns no matter what the underlying business is doing. But this forces you to ask a really tough question. Are they reinforcing the structure by rewarding the owners who believe in it? Or are they literally selling the steel beams from the foundation to pay for new windows on the penthouse floor? It looks fantastic from the outside, but it could be compromising the long-term integrity of the entire structure.
So, let's bring it all together. After putting Shell through the iron financial stress test, we have a very clear picture. We've examined the polished facade, we've gone into the sputtering engine room, and we've tested the cracking foundation. Now it is time for the final verdict. What we have here are serious structural weaknesses hiding behind a very aggressive and a very loud shareholder return policy.
Here is the final summary. The bull case, the iron frame of the argument, really it rests on two things: the highly profitable core oil and gas business that continues to perform, and the company's aggressive, almost fanatical, commitment to shareholder returns through dividends and buybacks. The bear case, however, points to the deep and growing cracks in the foundation. Cash flow is falling off a cliff, net debt is rising at an alarming rate, that chemicals division is a financial black hole, and the company can't even meet its own revenue targets.
So the final verdict from our stress test is a tale of two different structures existing inside one stock. One is a cash-gushing machine from its legacy assets, dedicated to rewarding its owners at all costs. The other is a debt-laden giant with multiple money-losing segments that seem to have no clear path to profitability. The question every investor now has to forge an answer to is this: which structure is going to win out in the long run? Is the allure of that dividend and that buyback a solid bedrock opportunity, or is it a carefully disguised structural trap designed to look appealing right before the foundation gives way? That's the billion-dollar question you have to answer before you build this stock into your portfolio.